Hello everyone, I hope you're doing well. This is Cameron here at Tactical Trading Services, and you're about to view video number 2 of our educational series titled Basic Option Lingo. So let's real quick get this out of the way. Risk disclaimer: futures and options trading have potentially substantial rewards but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures and options markets. Don't trade with money you can't afford to lose. This group is neither a solicitation nor an offer to buy, sell futures, options, or other financial products. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any material within this group. The past performance of any trading system or methodology is not necessarily indicative of future results. Alright, so now that we got that out of the way, let's move on. And so what's an option? I mean, I'm sure that everybody hears about options, and it kind of intimidates a lot of people. There's a lot that goes with options. A lot of weird terminology and stuff like that. So a lot of people just get scared off pretty quick from them. But realistically, an option, all it is a contract that gives you the right to buy or sell an asset at a fixed price for a specific period. So just a quick example off the top of my head. We'll say Apple. Say you buy a call in Apple with the strike price of $100 and the expiration date is October 1st. So if October 1st comes at market close, when the market is done trading for that day, if Apple is trading at $101, you can exercise that option, okay? And you can receive 100 shares of Apple at $100. That will be your base price. So immediately you will be in the profits on those 100 shares by $1, right? That is that's the primary definition for options. A lot of people don't use options in that manner. There's some investors and hedge funds and stuff like that where it's used in that way, but for us, retail traders and everything, that's not really how we go about using options. Basically, what we're doing is we are trading the premium price. Okay, so we don't care about getting assigned 100 shares. We don't care about exercising an option. None of that. We don't care about all that. We're just trading the premium. Okay, and so there's something that's called an option chain. And you may not be able to see this real well. If not, we'll have it on the next slide where I'll go a little bit more in depth. But this is your option chain, where basically what it is a listing of all available options contracts for an underlying stock, along with various data about the specific contract. Okay, so I'll move to the next slide where we got a full view here. And you can see here there's a lot of information, and I'll just point out, so this is an option chain for SPX, which is the S&P 500. Okay, the only expiration dates that I have selected is September 21st, right? Right here in the middle of your options chain, you'll have your expiration date. What this means is your expiration date is the last day that the option contract is valid. At the market close on expiration day, the contract will be no more. It will cease to exist. Okay? If that options contract is not in the money, it will expire worthless. All right? So let's talk about we'll just move to the right here. Strike price. Strike price, you heard me talk about it before. Strike price is the pre-agreed price per share at which stock may be bought or sold under the terms of an options contract. So that goes back to what I was talking about, if we wanted to get exercise, etc. But for us, strike price matters, but it doesn't matter as much as if we was wanting to own the underlying. So it's not really our go-to data whenever we're trying to find something to trade. The next section here is your bid and your ask. Okay, so the bid and the ask, it's the same as for stocks or whatever. Bid is, hey, there's people here wanting to buy it at this price, and there's people here wanting to sell it at this price. Okay, I mean, it's pretty much all it is. And the last column is the last price at which that contract traded at. So the last time that this contract went across the exchanges, it went across the exchanges at $13.73 if we're talking about strike price $33.15, okay? So the open interest is it basically indicates the total number of option contracts that are currently out there. These are the contracts that have been traded but not yet liquidated by an offsetting trade. Okay, so that means that this number right here, like if we're sticking with 33.15, that means that 723 contracts of the 33.15 puts with expiration date September 21st are out there in somebody's account active right now. Somebody has that trade right now and it has not been liquidated. So the next column is delta. I'm gonna reserve explaining delta until I believe it's the next video, where we'll dive into the options Greeks a little bit more. Implied volatility, I'll just go over it pretty quick because it's covered in the next video as well. But implied volatility is what the marketplace is implying the volatility of the stock will be in the future, and that's based on price changes in an option. IV is a dynamic number, and it'll change based on activity. And usually whenever implied volatility rises, the price of options will as well. So that's something to remember and take into consideration. So the next column here is probability out of the money, and you can see that right here. So basically, and this is on the other side as well, on the call side. It's just in a little different order there, but basically probability out of the money is a calculation that's done, and it's a real long mathematical equation, and it gives you a probability of this option, this strike price, and this expiration date of expiring out of the money. So you can come down here and you can say, okay, well, the 3,200 strikes that's expiring September 21st, that's got a 96.6% chance that it's going to expire out of the money. That's a pretty good probability, right? So a lot of times, we will look at that whenever we're selling options, is whenever I look at that the most. But it's something to take with a grain of salt, because in the live market environment, anything can change, and it can change pretty quickly. I would like to touch on something called in the money. Okay, and in the money, and I'll start explaining this with the call options. So for call options, in the money means that the stock price is above the strike price. Okay, so we'll go right here, and this is the left side will always be your call side, and the right side will always be your put side. So over here on our call side, we will say this right here, it starts with a background of black right here, right? And a background of blue right here, right? That's a very easy way for you to tell which options are in the money or which options are out of the money. So right here, all this blue, those options are in the money. Over here on these puts, those options are in the money. Okay? So basically you can tell, so this is a 33.15 strike call right here. Okay? And you can look up here in the top left corner and you can see at the time that I took this screenshot that the S&P was trading at 33.1947. So 33.1947 is above 33.15, but it's below 33.20. So there you can see your difference. And the same goes over here for your puts. It's just reversed for puts. But so now we'll say out of the money. So, and I'll say we'll start with call options again. Out of the money call options means that the stock price is below the strike price. And for puts, this means that the stock price is above the strike price. So you can tell again because this is highlighted a different color, and you can also tell because these strikes over here on the call side are above what we're trading at, so they're going to be out of the money. Okay, and out of the money, one thing that's important, especially if you're an options seller, to realize is that the price of out of the money options consists purely of time value, which is also called extrinsic value. And we'll get into that. We'll get into that a little bit more. I think it's on the next video as well. But just remember that. Remember time value, extrinsic value. So now for at the money, you have in the money, out of the money, and at the money. Basically, at the money is kind of like when the stock price is equal to the strike price, or a lot of times a lot of people will say one or two strikes away from the current underlying price, they will consider that at the money. Okay, and something else that we kind of goes along with out of the money options is intrinsic value. Intrinsic value is the amount that an option is in the money. Okay, and we will cover that a little bit further as well. So like I said, I just kind of wanted to give this really quick and down and dirty basic lingo class, because a lot of times I talk about stuff and people don't understand what I'm meaning by it or what I'm talking about. So yeah, I just wanted to throw this out there to everybody really quick, and I hope that it cleared up some things for you. And if there's any questions at all, please feel free to contact me. That's what I'm here for. I'm here to help you out in any way that I can, and I would love to do that if you had any questions. So again, if you do, just message me or whatever, and ask me, and I'll do my best to answer your question thoroughly. And if I don't know the answer, I'll go find it for you. So again, thank you. I'm glad that you have sat through this, and I hope that it's helped you. Thanks.